have Nesan with me today, Portfolio Manager with Sasfin. Thanks a lot, Nesan, for taking the time to come and chat to me.
Good to be here.
I think today I'd really enjoy unpacking this concept of investors becoming more worldly. The world has been said to become a smaller place through the advancements of technology, and very much so in terms of investments, access to investments. I think my first question would be to you, who's driving this worldly investment approach? Is it the actual client, or are we seeing it from the money manager side?
I think it's a combination of things. Several factors, some that are unique to the South African environment, but also the things that you've mentioned. It's a much smaller world out there. People are traveling more. They are using products that are manufactured in different locations throughout the world, and they want to know more about the companies that are actually manufacturing these things. Just look at technology, for example. A lot of people have iPhones. They want to know about Apple and what Apple's doing. And I think as that knowledge improves, an awareness of the investment potential of these companies has also come to the foreground. South Africans for a long time, you'll know, have been almost not been able to invest offshore because of exchange control, because of awareness of what was going on offshore, and because of sanctions back in the day. They just didn't have the ability to do it. But right now, I think the fact that a lot of the exchange controls have been relaxed, the South African economy has been lagging a little bit as well, so the need for other investment opportunities has naturally arisen. And I think that's been the major drivers for people looking for offshore investments in the last 10 years.
So being that push and pull factor, the portfolio managers now having to know a lot more. In the past it was just had to understand South Africa and the macro view. Now you've got this worldly view, and there's information galore out there.
Yeah.
I'm pretty sure your email inbox is full of research papers. You've got to manage money, you've got to build client relationships, you've got to handle interactions. All these things are on your plate. How are you taking all this information in to make informed decisions?
So, in terms of the skill set that's required to understand and to analyze investments, that remains the same no matter whether you're studying first-rand bank locally or whether you're looking at Amazon offshore. The metrics that you tend to focus on, the cash flow, the income statements, are more or less the same format. It's a question of, I suppose, using your knowledge and your experience in trying to filter out what information you don't need. I think portfolio managers are just these massive filters. There's a information overload, as you said, and what happens is you just ignore the stuff that you know you're not going to invest in, and that actually works out to about 80 or 90% of the stuff that comes through, and you tend to focus on the 10% of the businesses that you feel comfortable investing in. And what are those businesses? For me, it's businesses that have got healthy cash flows, healthy earnings, not too much debt, strong management. It's the fundamentals of running a business that I think are important ultimately to a portfolio manager wanting to invest clients' money into these shares.
So I think those are all right, and I totally agree with them. I think when I look at things like that, you've got on the left hand, you've got all these clients wanting to go offshore. And then on the right hand, they have all these new portfolio managers coming into the market. Yourself being an old hand, what advice would you give the new up-and-coming portfolio managers? Bearing in mind that it's pretty daunting out there. Asset allocations have definitely changed. Dwindling returns. You're now looking across a broader asset class. If there was something that you could give them as a piece of advice, what would that be?
Flynn, I'm sure there's something you will agree with. You're an old hand as well. You've been around a long time. You've seen the technology crash in the 2000s. You started your career then. In 2008, we all went through the meltdown, and we must have come to a stage where we asked ourselves, is there any reason for us to stay involved in this industry? Why don't we all sell our houses and go and rent somewhere? And what I think the important thing to understand from a young person's perspective is that the market is all about cycles. You must be patient. It's very difficult for younger people, I think, to be patient. Don't get stuck into fashion. Get to understand what your character, what your DNA is about. If you're a person that enjoys value and you're prepared to wait 10 or 15 years for a stock like PPC to recover, and it will recover, and you're comfortable with that, then that's the sort of investment you should make. But if you're the kind of investor that likes to see earnings growth and cash flow and new product and innovation, like we're seeing in the technology space, and you're not too unhappy about paying a little bit of a premium for that, then that's the sort of investment you must make. It depends on your personality, must suit your investments. And it's hard for a young person to know that. It took me a long time to get to know that. And there's certain types of investments I'm comfortable holding through thick and thin, and some I wouldn't go.
So I think your point around patience is key, and unfortunately patience is learned over time. How have you transitioned this onboarding of the learning of patience, and how do you portray that to your client? Because ultimately it's a partnership, you and your client. This is an investment partnership about providing returns, discussing. There's a lot of interactions. You have your views, your clients have their views, no doubt. But patience seems to be a key to that. How do you instill that into the client? How do you bring that across in a conversation?
If you ask how I learned to be patient, it's through making mistakes, being impatient.
Fair enough.
I can tell you, the only money that I've lost, or not the only, the most of the money I've lost in the investments I've done is because I sold too early, okay? Or because I bought too early.
But isn't it buy low, sell high? As simple as that?
So sometimes you buy when a stock is going down. You should be patient, because the market will give you an indication when earnings have bottomed out. That's really when you should be looking for, when earnings have bottomed out, not when the price looks cheap. When the market goes up, you feel, no, I need to take some money off the table, and before you know it, you're selling shares that are like Naspers, for example, that might actually double or triple in the next 2 to 3 years. The market is not giving you an indication that it's time to sell. Yet there's this feeling inside you that you need to take some off the table because you've done something good here, and you want that immediate satisfaction of having put the money in the bank. And I think for me, that is the challenge for a lot of portfolio managers out there. You'll never know when the right time to buy or the right time to sell is. But you will learn throughout your career about mistakes that you've made in the past. And if you can learn from those mistakes and you don't make them 10 out of 10 times, even if you make them 5 out of 10 times, you're still a better portfolio manager than you were 10 years ago.
Yeah, I think that's great insight. And I'd just like to circle back to this concept of being a worldly investor. And I had some insights the other day when I was calling around London, and the conversation was pretty strange to me in that I asked people on the ground how they felt we could compete in a world. We can't just simply rock up in London and manage people's money in London. Mm-hmm. And he actually corrected me, and he said to me, and I'd love to get your view on this, he said to me, the reason you will compete in London is because South African money managers and portfolio managers have had to be worldly. Like, the market isn't big enough here. We've gone through our challenges and all these things. So they've grown up having to be worldly. Whereas someone out of London, the market's big there. You have enough instruments. You can just trade on the LSE and you can carry on. Would you agree with that sentiment? If you do agree with that sentiment, is that something you work on every day? What's made you more, a worldly investor?
So I think there's a lot of truth to that. Necessity is the mother of invention, and the challenges that we've had in South Africa, certainly in the last 10 years, the lack of returns that we've seen from sort of 2013 onwards, has almost forced us to look elsewhere for returns. Of course, the availability of these technology platforms now to be able to invest has made it a lot easier. The relaxation of exchange controls I mentioned earlier on has also opened up the market for a lot of investors that didn't have the opportunity to see this as a new sort of investment that they can do, and they've embraced it as well. So I suppose, to answer your question, you do what you are more comfortable doing, and you learn, what you feel that you're able to learn. And I think for a lot of portfolio managers in South Africa, they've embraced it, and I expect that they will continue to embrace it. In the UK and in Europe, with the way things are going right now, those markets, I mean, they're going to have to embrace it as well.
Yeah, I would agree with that. I think the world's smaller. If you don't embrace it, you're just going to be left behind, aren't you?
Yes, absolutely.
Are you finding, being predominantly an equity-based allocator, that you're looking more to other types of asset classes? You know, is there a push from your clients, or is there a need coming out of your research that you need to be more broad across an asset allocation?
I think that's a great question. I don't think a lot of people give a lot of thought to that question. The US stock markets have been so kind to us now for so long that, you know, invariably you think you're Superman because you've held on to technology share for the last 10 years. But the question is it the right place to be in the next 10 years? Of course, you know, things like bond, the yields have been so low that people are actually not really interested in it. You can't really make a case for bonds right now, even for cash. And so almost through a process of elimination, you end up with equities. But having said that, the stock market is quite rich. And I think from the perspective of clients, managing money for clients, you actually want to stay as diversified as possible. So certainly in South Africa, we've increased our exposure to bonds. I think short-dated bonds probably, not long-dated bonds. You know, equities are a tough space to be in South Africa. And in offshore, we've tried to look for equities that give you more bond-like features. Okay. So better yields, better dividend yields in equities offshore, because, you know, bonds in Europe and in the US are sort of 0.5%, 1%. It's not really actually giving you anything.
That is always going to be your issue. You know? As soon as you try diversify into a yield play, you know, is there yield to be found in the world?
Exactly.
And people say no.
Well, some people have looked at corporate bonds, but they've also got expensive.
Yeah.
So you end up with almost, you know, through a process of elimination, with shares. And you know, so long as you don't over concentrate your exposure in one geography or in one specific share, I think you'll be okay.
What advice would you be giving to clients now? You know, we're coming out of COVID. No one's quite sure how we're going to come out of this. You know, there's a lot going on in South Africa. There's a lot going on in London, for instance. Actually, I guess you could say with Trump as well, there's a lot going on in the world. What advice are you giving clients now? How are you know what, let's stay the course. Are we looking to change? Where's your head at?
I think you want to stay very diversified right now. You know, if anything is certain, is that the world is in a constant change, state of flux, if you can imagine. The Chinese are fighting with the Americans are fighting with the rest of the world, the Europeans are fighting with the Americans. You know, it's a sort of space where you don't want to overexpose yourself to any specific area, while at the same time you have to be invested. There's no point in sitting in cash. Even in South Africa, there's no point in sitting in cash. Clients that have got a negative view on the economy, you know, are sitting in cash and earning 3-4% a year, and still have to pay taxes on that. So I think there's an awareness that you need to be invested, but there also should be the principles of investing, like for example diversification, should also be applied at the same time, so that, you know, you're never caught with your pants down, so to speak.
And you think that diversification is bringing the whole risk-reward ratio back into whack, or do you think there's still a bit of a disparity there?
It's a tough one. You know, it's obviously a question we ask ourselves all the time, because you don't want to be over-diversified, you know, because you have to pay fees, and then you end up, you know, with returns that you're not too happy about. But I think right now, let's get over Brexit. Let's get over this US election, because although, you know, everybody seems to think that Biden's going to win, we also thought Hillary Clinton was going to win the last time. So these are two big sort of macro events that are going to take place during the course of this year. And I suppose after that you'll have a much clearer view of where you want to be in. There's also the possibility that Europe certainly might be in negative interest rates for a long time. So I think that will help us guide clients into where the most appropriate investments are right now. And let's not forget, we've got the president telling us how we're going to recover from this economic calamity that we find ourselves in. So there might be opportunities in that too. So keep your powder dry, but at the same time, I think, be aware that there's a need to invest your money at some stage in the future.
Not keep too much powder.
Yeah.
Thanks a lot for your time today.
Thank you.
Truly insightful conversation. Your insights around worldly investment, I appreciate that. And good luck. I think the next couple of months are going to be a bit tough,
Yeah,
but we'll see what happens.